Hello, everyone. Welcome to Options Income Blueprint, Options Income Weekly Live. Today is January 9th, 2023 at 11 a.m. Eastern. You're here with Michael Schulman, and my name's Emily Norris with Traders Reserve. If you have any questions during the presentation, feel free to pop those in the Q&A box. We'll get to those once Michael wraps up. And just a reminder that we have live trading tomorrow at 11 a.m. Eastern. With that, I'll let you take it away, Michael.
Thank you, Emily. Excuse me. Not a way to start. Just to repeat what Emily said, we have live trading tomorrow, and I'm going to discuss a little bit today about trading. We're going to accelerate some changes we made in the sort of delivery of trading, so to speak. I'm going to go over the trades results from last week, which, of course, we just traded something. An alert went out a few minutes ago, and I'll discuss that as well. What I really want to talk about is trading earnings as they come about starting at the end of this week. Last week, we closed one winner. We were in a Chewy. We were out at Chewy. I didn't get an email about this, which means maybe people have finally understood how the market has interacted with the way we trade. And that's not meant pejoratively. It's not meant negatively that you haven't, but sometimes I do get emails going, why are we giving this cash back? Starting around the middle of the second quarter of last year, we sort of took on the persona of what you've seen if you've been a participant in Income Madness and getting quickly in and out of positions because of the nature of the market. And with that, we returned to a very, 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 very healthy track record of wins versus losses. And we also added into the equation, it was more important now to free up capital for the next trade or the next series of trades. So Chewy is a perfect example of that. Oh, I only made $19. Well, if you sold 5 contracts, you made $85. The rate of return was 0.6%. The annualized rate of return in 2 trading days was very, very high. In addition, we generated cash. We generated cash in 3 ways. We opened a new position in Chewy, giving some back to close it. We rolled our GM monthly down because of movements in the stock in the wrong direction for us. And we sold a trade desk position. So there are different ways to contribute to cash. And for those of you who are brand new or are not brand new, but have just lived off of alerts and have not come to a live trading session, cash is king. This is a cash income focused service. It's not what your portfolio is worth at the end of Friday service, and it's not a portfolio approach. So getting these kinds of returns, and I think the General Motors position was informative in that, yes, where it was just time, to roll certain things a little bit earlier and so forth and so on. We did that, or later, like on Friday. And the bottom line is to try to get healthy returns. And we rolled a General Motors and we got 0.5%, which is a very, very nice rate of return. So we in a certain sense underperformed because the amount of capital that we had out for the individual positions performed quite well, thank you, or had the potential to perform quite well. But I know we'll be back in the 30s again or high 20s again soon. And it was just a cautious week, a short week. And if we closed the trade desk on Friday afternoon as opposed to a half hour ago or an hour ago, then these numbers would have been radically different. And for those of you who had not checked your inbox, we did close the trade desk with a very, very, very tidy profit. We opened it on Friday, a $38 put. We closed it today, so technically that's 2 trading days, even though it's a 24-hour trading period. And we closed it for $12. We made $20, and $20 on a $38 put is a very, very, very healthy return in 2 days. It's more than 0.5%. So remember, we're sticking to those goals. And this is sort of a summary of what I just shared with you. So let's take a look at last week. The Fed minutes moved the market down. Why? The Fed minutes said we're going to stay the course, basically, and we're going to go after inflation and we'll do what we have to do. And that means raising interest rates as needed. So then the market saw labor force data at the end of the week. And the labor force data said things might be slowing down in the labor market in terms of both wages, which came in at 0.3% increase, not 0.4, as expected. And even though it was very robust hiring, was a little bit and robust unemployment numbers in a good way, they like what they saw in the market went up. So the zigzag continues. The zig and the zag is what we want. And it's very important that you accept this is what we want. We want volatility. Volatility is not risk. Repeat after me. Volatility is not risk. Now, for those of you who are in the Income Masters program in the boot camp of six-figure portfolio coaching, I do a self-assessment set of surveys. And the heart of one of them is, how do you define risk? Define risk. Risk is not what the risk is your portfolio will move from one Friday to another, or how a stock will move on a given day. That's volatility. What risk is a company's cost structure going to be such that they'll never earn as much money as they did last year? Is a risk the stock has been consistently overvalued for 10 years based on historical norms for the S&P 500? Is it going to finally come down to earth? Those are real risks, but not volatility. So we like it, accept it, embrace it, trade Chewy for a day. I do believe the market completely misread the Fed minutes with its reaction. Its reaction was a couple of points, a couple of percentages up, but the market, the bond market, when people look at the bond market prices out 30-day, 90-day, 180-day, 1 year, 3 year, 5 year, whatever treasuries. And taking a look at that, there's a number that comes up with where they think interest rates will go. And the market is still forecasting a flattening of rates and a possible to probable downturn and a cut in the fourth quarter. And it's not going to happen based on Fed comments, not based on my opinion, but based on Fed comments. And here's a comment from the chair, the Board of Governors in Minneapolis Fed, a former staffer for Hank Paulson. A lot of credibility, does not speak out of turn, doesn't argue with Dr. Powell in public. And he says, we're going to stay the course. Hey, the market's got it wrong. We're staying the course. We're going to do what we can do. Now, one of the hidden things that's going on is the Fed knows it can't affect food prices, and the Fed knows it can't affect gasoline prices, and the Fed knows that if there's a housing slowdown, which there is in terms of homes purchased, it only affects a small part of the population, and perversely, it can drive rents up. They're not sure. The point is, the three drivers for the average American of inflation are not something the Fed can take a whack at. Regardless of what people in Congress will say, the government spent too much money and there's too much demand. Well, there was going to be too much demand after the pandemic ended anyway. And the demand is for things that are very discretionary, like travel, which we'll discuss in a moment. So core inflation, the Fed knows it can't do too much about, but it does want to start getting us back to where interest rates can have an impact. That'll be years from now on some of the core things. But most importantly, is where I'm going with this, because it relates to the earnings announcements coming out this week. What the Fed wants to do is make sure that an inflationary mentality does not take hold. An inflationary mentality took hold in the United States in 1971, when, even though 73 was the great oil embargo, 71 was when the Saudis nationalized Aramco, and the price of oil started to go up significantly. It's when we got off the gold standard for that reason. And curiously, by the way, is when the microprocessor was invented, all within a 6-month period. It's a big year. And the bottom line here is that kicked off inflation that became inflationary mentality, which ended up with 19% interest rates. And then Paul Volcker, not Ronald Reagan, Paul Volcker, the Fed, broke inflation. And then between that and ebullience about tax cuts in 1981, the market took off, and we have been in a bull market in stocks and bonds. Forget crashes. They're crashes. They're not structural changes, underlying movements in the market, for 40 years. And so this market is not used to dealing with an interest rate driven bear market in bonds. And that's where we have the zigzag. And here's the zigzag. It's a move of just 3%. You're going, oh, 3% is a lot. No, it's not. Prior to some stability that we saw starting before the pandemic, or a couple of years before the pandemic, 1.5% to 1% movements in the averages was typical. And what we see here, though, is because the S&P is not at 660, which it was at the bottom of the 2008 crash, and it's at 3890. The movements seem gigantic. Oh, the S&P is moving 60 points. Well, 60 points is not that much. It would be if the S&P was at 1200, it'd be a 5% move. But here it's less than a 2% move. So, but that's good for us, because it means there's lots of premium when we zig and zag on different levels in a stock, because the stock prices themselves are not elevated based on value, just elevated in terms of raw numbers. let's get to stocks. So there were 4 earnings announcements, maybe 3. So that is Delta, JP Morgan Chase, Taiwan Semi. One source says the 12th, the other says the 19th. We'll see. We're not going to trade it probably anyway this week. And KB Home. And let's go through what they mean. Delta Airlines has never been a bellwether except for the travel industry and the 4 mega airlines. The other 3 are United, American, and Southwest. But more and more travel is looked at as a bellwether of consumer discretionary spending in 2 ways. Are consumers continuing to spend discretionary funds? And are they continuing to shift away from traditional hard goods and stuff and retail and clothing, whatever? It's Friday morning. It'll be, and it doesn't mean we'll trade it Friday morning, but it's an important number depending upon what they also say in management comments. Ditto for JP Morgan. JP Morgan is the mega money center bank. Between its credit card operation, its consumer banking operation, its investment banking operation, its bond trading desk, its equity trading, and its investment banking, it really is a player in all of those aspects of money center banking. While Goldman Sachs doesn't really have a retail and they wish they didn't have a credit card presence, and Morgan Stanley is a smaller version of JP Morgan. Bank of America is the most powerful retail bank in America. It owns Merrill Lynch, but doesn't have a meaningful, what I would consider a meaningful investment banking operation. So JP Morgan and Jamie Dimon's management comments on Friday morning will be very important in setting the stage because a lot of the other banks announced that day or Monday and Tuesday. The regionals announced towards the end of the month. I'm going to skip to KB Home. KB Home is the housing companies are all in our price ranges. We could trade Pulte or Toll or KB Home or DR Horton, any others, Lennar. And the bottom line is, I believe the street has finished its journey from measuring home builders' revenue and unit sales to profits. And what's really fascinating about the home building industry, and I'm really, really curious about what they say, is imagine that a home builder was a utility, meaning very, very high fixed costs. And when they add a new customer or they add a new amount of power, it can affect their profits. But let's look at it in the opposite direction. KB Home has very, very low fixed costs. They have their balance sheet, which holds their land. And then if they think a market is going to accept a home for $350,000, they go out and they spend the money to build it. If they don't think the market is going to support a house for $350,000, they sit on it. And so they have enormous flexibility, being at the inverse of a utility, meaning they can manage their costs to profits, to targets, to what's going on in a local market. And that they've always done it, but that wasn't the way Wall Street measured them, and now Wall Street does. So you can anticipate we're going to trade the home builders aggressively if they're liquid enough in the quarter. Now let's get to Taiwan Semi. Whether they announce this week or next, the issue is they're 10 times to 20 times to 30 times bigger than the next biggest foundry. A chip foundry makes chips for other companies. So Apple wants a chip for its iPhone, probably Taiwan Semi is making it, if Apple designed the chip. And they're investing, it was 20 billion dumped this year, and they're investing, and they're removing, especially advanced chips, they're building in Europe and the United States. They've taken hits because of scurrilous headlines about China invading Taiwan. Scurrilous is the kindest thing I can say. And but they are considered a real bellwether of growth, in that their order backlog and their revenues and their profits tell the world, okay, tech assembly of devices is at X, which means our sales are at Y, and their management forecasts, and they're considered a real bellwether of growth because a lot of discretionary money, business discretionary and consumer discretionary, goes into computing and phone devices. So how do we trade them? Before I get to the bullet points, let's take a look at Costco, which we won't trade because of its price. We may trade it with spreads in the Income Masters program, but Costco saw revenue go up 6%, which compared to inflation means their sales were either flat or lower. But profits were very solid, and they went up 7% because the street was expecting something worse. And more importantly, all the metrics, how Costco measures itself, and remember, gasoline prices started to go down in the fourth quarter. So actually their core sales were up over and past the rate of inflation. And many people just trade on a headline. But if you peel the onion of their earnings, very solid performance in Costco also. And the reason I'm bringing it up is how we would trade another stock that comes out of earnings. They have a tremendous reputation on Wall Street. The two leading managers have 76 years of combined experience at the company. That's the foundation for how Wall Street's going to react to a trading announcement. And so we trade after an announcement. We only trade stocks where that foundation is in place. And we're going to trade after an earnings announcement. Why? What risk is there? I mean, the press release is out. We can see the initial reaction from day traders. We can then start seeing analyst comments, what have you. And so you can look for an alert, perhaps the same day, but typically 1 to 2 days after. Why? Premiums linger. A premium buildup before a major announcement is big. Premiums they're like a balloon that's inflating with expectations, negative and positive, about earnings. Well, the balloon isn't popped, it deflates. So the premiums in terms of the time value start to shrink as soon as the announcement come out, but they're still very, very hefty. So we can look forward to, from the 13th to about the 5th, 12th of February, 13th of this week, lots of earnings that we can trade after the earnings come out. But what are we going to do this week? Will the market calm down? You have to define calm. I want to go back to volatility is not risk. And you have to accept that to make money. I can't draw a finer point on it. The short-term support for the market, which is proven to be a short-term support, is 38.50. If the S&P continues to hold, if JP Morgan has bad news or what have you, if the market sells off, the sort of the interim, I would call 20 to 50-day level of support is 36.50, maybe a little lower, or maybe a little longer. And trading volume is definitely picking up. The holidays are over. So this quarter, in terms of how we trade, do not be surprised if more and more of our live trading sessions are one trade, not two or three, answering lots of your questions. And maybe if time allows, if I think it's appropriate for the time, discussing a tactic or discussing a specific stock in depth for, let's say, 5 minutes, sort of an educational component, not every week. It just depends upon where I think we're at and what people are interested in. But I want to go back to closing the Chewy trade in one day, closing the trade desk trade in one day. We're going to close our trades when we hit our goals. Now, if the chart tells us and the trading tells us it's going to run, then of course we wouldn't do it. But with the trade desk, for example, which we closed, we had Emily and I discussed this both on Friday and this morning. What are you willing to close it at? And I said, I want to get at least 20-cent profit when we hit the number. So then you look and you go, well, action for the last 15 minutes, it's slowed down a little bit, and we're nearing 4,000 on the S&P 500. We're getting into the area where professional traders know we're nearing 4,000, which means you could see a lull. We've got the goal. We've hit the goal. Let's run. Let's close it up and lock in profits and free up capital for all of us to trade tomorrow. So with that, let me go to your questions.
Michael, we don't have any questions at the moment.
Well, let me discuss the two things I think I may add or will add anecdotally to trading sessions. Sometimes I'll go in depth for 5 or 7 minutes or whatever. I've really had a trade after earnings, and that I alluded to this week. It's about, you could get into real technical stuff, what the implied volatility is, and over the last 4 earnings announcements, what the trading ranges and implied volatility were, but you have to be someone who's keeping logs and charts and stuff like that. So it's not going to be super, super technical or detailed, but it may be get your portfolio ready, get your cash ready, get your capital ready. We have 5 weeks of earnings coming up, and you have to be aware that we may be putting on more positions than normal, but on the other hand, we'll be closing them and so forth and so on. In terms of looking at a stock, I've done this before. We might pick apart, there was a new survey that came out on pet ownership, and we might pull Chewy apart and go through it at length. Or when Delta's announcement comes out on Friday, in the update, in the trading session on Tuesday, I might pick apart the competitive advantages or disadvantages of the 4 major airlines and what I see, that kind of thing. Any questions now, Emily?
Yeah, it says Don says, if you expect just one trade live, do you intend to send more trades out via alert?
Absolutely. I'm still committed to at least doing 2 trades a week. We try to do 100 to 115 trades a year, plus rolls. Rolls do count, meaning when I do recommend a roll where you can get into the second leg, which was not the case last week. Those are fresh trades for many people. So yes, I'm targeting at a minimum, on average, that would be 2 a week or 100 a year.
Okay, that seems to be it for questions.
Well, thank you all. Thank you for listening, and I will see you tomorrow at 11 Eastern time.
All right, thanks, Michael. Thanks everyone for joining us. We have recorded this session and we'll be posting it to the member website as well as sending it to you in your Options Income Weekly newsletter. Just a reminder, we have live trading tomorrow at 11 a.m. Eastern. And as always, please keep an eye on your inbox for alerts managing open positions and potential new trades. Thanks and have a good day trading.